Welcome to the Market Intelligence Report from Hollow Point Trading. This video will provide a full market breakdown of NVIDIA's Q1 FY2027 earnings and the conference call analysis from May 20th, 2026. This report is divided into 8 sections, covering NVIDIA earnings and live reaction, technicals, market scoreboard, indicators, macro risks, commodities and the Fed, historical parallels, and finally, a watch list and conclusion. We begin with Section 1, NVIDIA earnings, focusing on the numbers, the live reaction, the conference call highlights, and what the street might have missed. NVIDIA beat expectations across the board for Q1 FY2027. They reported $81.6 billion in revenue, $1.87 EPS, a 75.0% gross margin, and $75.2 billion in data center revenue. Despite this, the stock dropped 3% initially, showing that expectations were already high. The data center segment is clearly the main driver, accounting for 92% of the revenue. Key highlights include the massive growth in data center revenue, led by networking, and cloud providers still making up about 50% of data center revenue. Q2 revenue guidance is a monster number at $91 billion, crushing the street's expectation of $86.8 billion. Crucially, this guide assumes zero China data center compute revenue, suggesting pure upside if conditions change. NVIDIA is maintaining its platform moat with current Blackwell production and the next-gen Vera Rubin. Blackwell is ramping hard and underpins most data center revenue. Vera Rubin's full production started this quarter, with projected revenue of $38.2 billion in FY26. In terms of capital returns, NVIDIA has a total buyback capacity of $118.5 billion. They announced a new $80 billion buyback and a massive 2,400% dividend increase. Some view the dividend hike as a sign of slowing growth, but the guidance suggests otherwise. The conference call featured Jensen Huang's quote on the largest infrastructure expansion in human history. Key call points included a potential $3 to $4 trillion in annual AI spend by the end of the decade, and the fact that no China compute revenue was assumed. The live reaction showed an immediate drop of 3% on earnings, followed by a bounce as traders absorbed the numbers. However, the stock faded again during the call, as selling resumed. The key reason for the drop was a minor margin adjustment from 75.1% to 75.0%. This 0.1% move erased billions in market cap. Also, higher inventory and operating expenses contributed to the selling. China remains a critical factor. The headwind is clear with zero China compute revenue in Q1 due to export restrictions. However, the upside is substantial, as the $91 billion guidance assumes zero China sales. NVIDIA's earnings history is a clear example of sell the news. The stock has dropped on 4 of the last 5 revenue beats. The market uses strong headlines as exit liquidity for institutions that positioned weeks ago. In options flow, the $220 level is critical for gamma level analysis. A close below $220 means accelerated selling due to gamma unwind, while above means accelerated buying. Market makers will need to delta hedge if this level breaks. Comparing the AI situation to the dot-com bubble, the technology is real, but the investment pace is parabolic. The question is when returns will justify the enormous capital expenditure, signaling a potential bubble burst despite the technology's long-term promise. Let's review the semi-names. Winners included ARM, Micron, and SOXL, showing strong performance or positive setups. Potential losers included AMD, as shipping comments were not great, and Intel, whose future depends entirely on its own print. The bottom line is that the market's bar has been set impossibly high. NVIDIA delivered a blockbuster quarter, but the stock is flat. The reaction suggests that smart money is distributing. We are in a state of bullish earnings but bearish tape. Moving to Section 2, NVIDIA Technicals, we'll cover the chart setup, divergences, semiconductor performance, and option structure. On the daily chart, a divergence is forming near major resistance. The MACD has rolled over, and there's a possible lower high developing. Several divergences are confirmed, including the rate of change and stochastic indicators. Looking at the weekly and monthly charts, divergences are clearly visible. The weekly chart is at the upper channel from the 2022 bottom. On the monthly chart, momentum is rolling over, and the pattern is similar to the 2000 and 2007 tops, suggesting a possible reversal. The SMH Semiconductor ETF is a canary in the coal mine and is rolling over. If NVDA rallies, SMH fills the gap overhead. If NVDA fades, SMH rejects at the 20-period MA, confirming a rollover, which could lead indices lower. Section 3 covers the market scoreboard, including daily performance, gap structure, and S&P and NASDAQ analysis. Today's rally was temporarily fueled by a drop in crude oil and a pullback in the 10-year yield. The Russell was the best performer. Key observations show a 7-week winning streak, but the markets are barely above the prior week's close. For the S&P 500, the gap is critical, with gap resistance at 7,450. On the 15-minute chart, we saw a bullish falling wedge breakout. However, daily concerns include a rising wedge breakdown and a potential lower high, similar to past market tops. The S&P weekly and monthly charts are at the upper channel line from the 2022 bottom, a major reversal zone. We have a 7-week winning streak, and a candle of decision is forming. Monthly divergences are confirmed, suggesting time is running out for the rally. The NASDAQ 100 daily chart shows a broken rising wedge and stacked divergences. On the 15-minute chart, a bullish falling wedge is surging toward gap resistance. Daily concerns include the broken trend line and the potential completion of a 5-leg push higher. A potential intermarket divergence is forming between the NASDAQ and S&P. NASDAQ already has an RSI divergence, while S&P does not. If S&P fills its gap and NASDAQ cannot, it's a massive warning sign, historically preceding major tops. Now we move into Section 4, covering indicators and internals, including the VIX, Elliott wave analysis, and intermarket signals. The VIX shows a bullish falling wedge breakout and is hovering just below the 200-period MA. We need the VIX above 50 on the daily RSI for volatility to return. An Iran operations catalyst over the long weekend could lead to a hard spike. Elliott wave analysis suggests the 5-leg push higher may be complete. If the count is done, we could see a lower high, followed by a devastating wave 3 down, similar to the market collapses in 2000 and 2007. We now move to Section 5, which discusses macro risks, including crude oil, Iran, bond yields, and the coming reality check. The market is currently pricing in a peace deal with Iran and subdued crude prices, which is likely incorrect. The reality is that no concessions have been made. U.S. combat operations may resume, and an oil shock could lead to inflation and market collapse. Looking at the Iran timeline, Trump's pattern is diplomacy first, then force. Iran's miscalculation that he will settle could lead to resumed strikes around the new deadline this weekend, potentially after the market close on Friday. Both the 10-year and 30-year yields are forming large triangles and are ready to break out. Despite experts predicting a collapse, I correctly called the bottom. Surging crude oil will lead to an inflation spike and push the 10-year yield above 5%. The Federal Reserve is in an impossible trap. An oil shock and inflation spike will cause markets to crash. The Fed will panic and be forced to make jumbo cuts, choosing to support the economy over fighting inflation, just as they did in 2008. Next up is Section 6, Commodities and Broader Markets, analyzing oil, wheat, Bitcoin, and other important market movers. Crude oil is at a triangular apex, with a breakout imminent, despite today's drop on fake peace hopes. I believe commodities like oil and wheat are going much higher. Meanwhile, Bitcoin signals are turning bearish. We now look at Section 7, Historical Parallels, examining the blueprints for market collapse from 2000 and 2007. The current market pattern mirrors 2000 and 2007, a bottom, a sharp rally, a small drop, and a rally above the prior high. Now, we face the risk of a lower high and a substantial sell-off, with a worst-case scenario of a 2000-style collapse. Finally, Section 8 provides a watch list for tomorrow. Key things to watch include NVDA's price action around the $220 gamma level, the S&P gap fill at 7,502, the crude oil triangle, and any signs of market frothing as small caps lead. This concludes the Market Intelligence Report from Hollow Point Trading. Thank you for watching. Remember to follow for more market insights.